You probably remember the movie The Big Short, and if you don't, here's what happened. Michael Burry, a US-based hedge fund manager and founder of Scion Capital, rose to fame after predicting the 2008 housing crash and making as much as $100 million in personal profits, mainly through a few out-of-consensus bearish bets. That means he could see that the market was going to crash before anyone else did and really capitalized on it. Now, filings for the second quarter show Michael Burry's Scion Asset Management took an $886 million bet against the S&P 500 and another $739 million bet against the NASDAQ. That's nearly 90% of Scion's entire portfolio. Let's try and understand a bit more about it with Lukman Otanuga in London. He's Senior Research Analyst at FXTM. Thank you for being with us today. Lukman, is there something that Michael Burry knows that we ignore? Because there seems to be a rally in equity markets, a big one that started October last year.
Thank you for having me here, and those are certainly big bets indeed. We've seen the S&P 500 gain over 15% year to date, and the NASDAQ is up almost 40%. We know that the primary forces behind these whooping gains have been the AI mania that has seen investors rush towards tech stocks. Also, there's hopes around the US economy heading for a soft landing rather than a recession, and the global hacking cycle coming to an end. Adding to this is what's really been supporting stock markets in the short to medium term.
And that's interesting. And as you say, a soft landing may take place at this point, right? What every investor wanted. So what's the point now of going bearish and betting against the markets? Do you think it could be an interesting and lucrative position?
I mean, removing the above from the equation, I think concerns still linger over the global economy. Today, we saw China's central bank surprise with a rate cut, followed by an influx of negative economic data, showing that the world's second largest economy is in trouble. There's still a disconnect between the Federal Reserve and markets, with markets thinking rate hikes are over, but the Fed still possibly signaling one more rate hike. And when you consider how global sentiment remains fragile and heavily influenced by all these negative themes, there could be a reason behind this. I think further signs of slowing growth in the world's largest economies and signs of still sticky inflation that may result in higher rates could trigger that sell-off across global equity markets.
We'll keep following those positioning. Lukman Otanuga, thank you very much.
Thank you.
And now let's go to other stories from around the world. China's central bank has unexpectedly cut a key interest rate for the second time in 3 months in a bid to help boost growth. The People's Bank of China lowered the rate on its one-year loans by 15 basis points to 2.5%. Meanwhile, China's Statistics Bureau said it had halted publication of youth unemployment figures, which was seen as a key indication of the country's economic slowdown. Japan's economy has grown more than expected in the second quarter, despite a slowing post-COVID consumer recovery. GDP expanded by an annualized rate of 6% in the April to June period, as weaker yen boosted exports. The growth was also boosted by tourist arrivals after the government lifted border restrictions at the end of April. And unemployment in the UK rose more than expected in June to 4.2%. The figure was up from 4% in May, indicating a slowdown in hiring as the latest cycle of rate hikes is reducing consumer demand. Despite this, the median monthly pay also rose by 7.8% year-on-year in July, with analysts mixed about what the central bank will do next to tame inflation.